you're trying to get enough return to satisfy your objective while at the same time never putting yourself into the stress of being a highly leveraged trader, in my mind. That's what I shoot for. So the volatility targeting, when I look at a position, I look at it from a risk as a percent of equity and a volatility as a percent of equity, because the two are both very different forms. Volatility is not risk. Risk is how much money can I lose on this trade. Volatility is how fast is this thing moving. And I like to limit both to a specified number that I, as a trader, feel comfortable with both of those levels, and I don't exceed them. Now, if I'm into a position and it's going my way, I have a second set of limitations that are higher than my initial position. So if I start with like a 0.5% risk, I'll allow a position to get up to 1% risk if it's profitable, because I'm sort of playing with the market's profits.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Welcome back, everyone, to the Algorithmic Advantage. If you're enjoying the ride with us, then please get on our website, check it out. There's a lot more on there than just the podcast. We are now writing some research, and we've got blog posts on there. We've got tools for traders if you want to know the data, the backtesting engines that we use, that kind of thing. Get on the site, check it out. So on to the show. Rich, today we're very lucky to be talking to Tom Basso. Tom, welcome to the show, mate.
Hey, good to be here, guys.
As I said before, Tom, this is a tick off my bucket list, so be aware.
We've got lots of interesting things to chat about. We literally have to start with the state of the market. So it's the 6th of August, 2024. The markets have just closed a few hours ago.
Bloodbath.
There is blood all over the walls. I think the VIX has had its if not its biggest one-day move, it's in the top 1, 2, or 3 moves. There has been some really violent action for a couple of weeks. Really, there's a lot of chatter about the yen carry trade unwinding as the Bank of Japan has raised interest rates to 0.25% from zero after they have been at zero for a long time. So it's a bit of a shock to the world.
Crypto hasn't come to the rescue.
Crypto hasn't come to the rescue. So there's been not a lot of places to hide, except perhaps in the nature of your strategies themselves. I mean, I'm one of the lucky ones trading strategies. It actually had a great day. But yeah, a wild ride. So we're talking to Tom Basso, who of course is Mr. Serenity, as your mate Jack Schwager called you when he interviewed you in the New Market Wizards books in the early 90s, the New Market Wizards book. And but is there serenity today, Tom? Are you still in a state of serenity?
Yeah, I really am. I did everything today that I normally do. I came in the morning, I checked out the overnights. I fortunately did not spot a single trading error from over the weekend. That was great. Made new equity highs this morning. Just watched the rest of the day and saw some of the records and heard some of the comments. Spent a little time jotting down some thoughts for my Substack account, that just whenever I'm in the mood and there's something I think that might be useful for traders, I'll jot down a few paragraphs or throw a graph in there or a picture or something. And then I went to social media and got linked up to the Substack piece, got that out there. Market closed. I had lunch. Market closed. I came back down, ran my afternoon run that I call. It's a process of data inbound, processing the data to some extent, and in a couple of places I still have to do a few things manually, and get all the orders in there and the stops, and then I got prepped and went online for you guys.
Tom,
Pretty normal day.
Simon sent me your Substack article, and it was a really good article that you wrote about the volatility today.
Thanks.
Can you just step through that, just for listeners out there? Give them a bit of hope, Tom. What is the core messages?
Well, if you're trying to be Mr. Serenity, you got to approach it a couple different things. It's a lot about your mindset, because for starters, no matter how algorithmic you are, and I know that you guys are the algo advantage, you can always, as a human being, step in and get in the way of your algo. You have everything systematized, and then you decide, I don't know, the stock market just looks really terrible, and the algorithm's saying you should buy this dip, and you don't want to buy the dip because it looks like it's melting down. There was a bunch of traders, for instance. Good example of this is CTAs in the US during the COVID crash. And crude oil actually went negative. Standpoint actually had contracts that went negative.
Yeah.
And we were forced by the Futures Commission merchant to take our profits on that, because they didn't know what was going on. They sure didn't want to take delivery. And they said, look, roll out to some future contract or something. The one that's the current month is negative. We can't handle that. We're going to protect the firm. But we ended up making a massive profit on it. And I think that it's really easy, though. And sadly, a lot of CTAs literally shut down their trading. They're algorithmic. They're got the systems. They got the data. They've done all this homework. They've done all this research. And then they just get emotional and say, wow, this looks like the whole world's going to end. Let's go to cash. And then there was all those people that said, well, we got to get a test of the bottom before it rallies. And it didn't test the bottom. It V-bottomed and off you went. So a lot of people missed out on a lot of the upside. So they missed the downside, they missed the upside. They have a crappy year, and all they had to do was just do what they're doing. And that's what I did. I try to make every day the same. If you're concerned over the amount of volatility that you're experiencing, there's other ways, I think, of better dealing with that than to just arbitrarily step in with a bad mindset. So the article I wrote was about mindset, and it was about basically trying to get your mind right so that you can exploit up markets, down markets, sideways markets. Don't limit your thinking. Try to stay dead neutral, ambivalent as to whether it's going up or down. I don't really care. I mean, today was a good day for me, but it's the same day I would have had Friday. Friday, I made a bunch of money too, but there was no difference in the timing and the data and the process, and it's all the same. And I'm open to whatever comes our way. If tomorrow the market goes crazy up and I get a bunch of signals to buy, I'll cover my shorts and go long.
So you've managed to separate your systems from your mindset effectively. You've separated them out.
Right. I'm a human being, and when I see a big positive day that's multiple percent or something, kind of catches my attention. And if it's going my way, it's not going to hurt my mood any. But in reality, it has nothing whatsoever to do with my trading. Nothing. And I think that's the key, is to get into that mindset. And I think the other thing I added was a little thing about position sizing. I think a lot of people get distracted by the speed at which their portfolio is going up or down or making money or losing money. And I think a lot of that has to do with how have they sized their positions. If they keep the positions sized so that it's small enough so that it's not going to impact their emotions too much, then it's a lot easier to be serene about your trading because it's just another day. If you're starting to see your account go up or down 5-10% in a day, you got some leverage there, and you might want to just back off of things a little bit.
Yeah.
And that's going to make you more emotional, cause you much more difficulty in trying to maintain a good mindset for trading. So I think you want to try to, yeah, sure, you want returns and you want to get your returns up there to suit your objectives, but you have to also live within your own mental capability of dealing with the swings. So it's kind of a trade-off is the way I look at it. I think I personally am in a nice sweet spot for me. I noticed that we were talking with Jerry Parker back a year ago or something, and I noticed he said something about 0.5% of his equity per position in risk. He trades a lot more positions than I do, so his total risk of his portfolio would be greater than mine. But I trade my positions. I have 35 positions, I think, right now, and they're all 0.5%.
But I think you've got a lot more system diversification than Jerry, so you are extensively diversified.
I trade about 7 different strategies across 35 different markets, across 5 different time periods or parameters, from very short to long. And I use 5 different indicators to do it.
That's reducing your bet size to tiny bets. So in other words, with your level of diversification, you've reduced your position size to a position that you're very comfortable, because each individual position in the scheme of things has very little impact on the overall next 2,000 trades, next 3,000 trades, or whatever.
Well, and some of the systems actually will counter-oppose each other by design almost.
Yeah.
Like a simple example would be, say you've got a stock market that's gone crazy for a long period of time upward, and it's a long-term buy then. So you've been long, you've enjoyed the ride upward, but then you got a short-term trading strategy that's ready to turn on a dime, and the thing starts coming down and it triggers. So now you have a short position in the stocks and you have a long position in the stocks, and you look at your list of positions and it says 0 next to it because they've offset each other. And so you can kind of be a little bit more leveraged, and if they all line up, actually do have a very strong day on a position if all of the strategies are lining up together. But when they fight each other, like in a sideways market, you find yourself at 0 a lot, which is then saving you a lot of money in whipsaws and all that. So,
right. I'm looking forward to getting into the strategies, Tom, and asking about the different types of strategies that you have, how you fit them together as your whole portfolio. So this is great. We're straight into the thick of it. This is the style here at the Algo Advantage. We kind of have decided to dispense with a lot of the history. You know, people know most of the guys we're talking to, and so we do jump straight into it. But of course, just to cover a little bit of that, we know that you were trading somewhere around 600 mil for Trendstat back in the day, and have otherwise been retired for quite a long time, doing your trading, educating, helping others. Obviously, as I mentioned earlier, you featured in Schwager's new Market Wizards book. I'm keen to ask about your interactions actually with Jack, and also with Van Tharp, because I've heard you mention your relationship with him, and of course, you know, now you like your dancing, you're singing, you're golfing, you're cooking.
Retirement's been fun.
Retirement. What's your handicap these days?
Yeah, that's interesting. I got down into the single digits. I was an 8 or a 9, and then I had 2 different injuries that kind of took me about a couple years to work through. When I started changing my swing to accommodate my injury, it kind of messed my swing up, and it's taken me forever to find it again, but I have started finding it, and my handicap's down. It topped out at around 14, and I'm back down to a 12
Oh,
going
well done,
lower.
Tom.
So,
Yeah.
but
Excellent.
next Monday is my 72nd birthday. So for me to be a 12 handicap
12
and on my
marker.
way to maybe back to a 9.
I think you were saying to Andrew
You're happy.
Swanscott, Tom, in your last interview with him, that you're almost at a position where you've been in retirement longer than you've been trading. You've got another
Yes.
7 years to go.
And that's why I smile a lot.
Indeed. Love it. Well, my handicap's my golf swing. That's another story, but I love the golf as well. So I'm keen to, I guess, just backtrack a little with this initial question, of course, is just how systematic are you? So Rich and I are obviously 100% rules-based, 100% systematic. In my case, it's 100% automated as well. So I monitor everything, but the trades go on themselves and so on. So where do you actually sit these days, Tom? Like, obviously, you're very rules-based.
Yeah, there's no discretion at all. I'm totally systematic. I've got 6 of the 7 strategies totally automated now on a platform that I'm consulting on called SimTrader. And it's a group up in Michigan that's putting together the platform in the cloud. And they're using me as not only an alpha tester and guinea pig, but they're also taking my advice largely in an effort to try to put into place a lot of the things that I learned from my days at Trendstat and my research that I've done over the years. They're building the tools that I think are necessary to make it one of the best platforms that I've ever seen. And that platform also, we call it SimTrader because it does simulations, and then it will also trade for you. It'll actually allow you to ship the orders at first to IB, which is who I use, Interactive Brokers. But ultimately, they may add other brokerages as that the brokerages have that capability. So we've been working on that 4.5 years now, and we're getting into the late stages of it. But sadly, it's not even ready for beta testing yet. It's getting closer, but I'm starting to see a little bit of light at the end of the tunnel. It's been a long, long road. We started it just before COVID.
It's such a big job. I can see why it takes so long.
The Trendstat at its peak, somebody asked me, how much did it cost for you to create all this simulation and trading software for Trendstat for managing the 600 million we had? And I actually took the employees for the years they'd been with me, roughed out their salaries on an average, multiplied it times all their benefits, took an estimate of the number of computer equipment that I had purchased and all the software that I purchased. And I came up with roughly $1 million it cost me to build all that early, and that was over a 10-year period. So we're doing it for a lot less, probably on the order of a few $100,000, and we're doing it in 4.5 years. So,
and what about for your back testing and the like, Tom? What do you do? What kind of platforms do you use, or software do you use to do research?
Well, it depends on if it's a simple, quick and dirty. I sometimes just go on my IB screen and I eyeball it. That's one way. And another way would be just to take an Excel spreadsheet. They're so much more powerful than they were back in the 1980s when I first bought my first IBM PC. So I can do a lot with a spreadsheet if I need to do something, just drop down some data and just test something and see how it flows. If I'm doing something serious where I want a simulation that covers a long period of time and say 20 different futures markets or something, I'm probably going to rely on SimTrader to do that. And it gives me great statistics. I can get a feel for how something would flow. But it can't do everything. So it's getting to the point where it has the capabilities to do that. And it even's got it's got the ability to customize the indicators. So when it gets to the point where we're in beta, I can run some additional tests that I can't quite run right at this moment. But it's going to be pretty powerful, and that's probably what I would use in as a preference rather than even an Excel spreadsheet, because it's just faster.
Yeah.
All right, Rich, let's dig in with Tom on his whole all-weather approach. You were mentioning you've just recently enjoyed his book, The All-Weather Trader?
The All-Weather Trader.
Yes. So, yeah, let's dive into that a little bit. But, yeah, for sure, after that, Tom, what I would love to do is actually just get a brief overview of the number of strategies that you trade, what the sort of objectives of them all are. I'm interested in the mix of trading futures plus ETFs, whether there's any individual stocks in there as well. I enjoyed I think it was your penultimate Substack piece, actually, where you did sort of talk about the different strategies that were being traded. The capital allocation piece, cash efficiency or whatever it was.
Right, capital efficiency.
So yeah, I'm actually keen to know about that. We love the idea of trading, obviously, multiple strategies for multiple weather events. So I'm keen to know about just how many weather events you have planned for, and what kind of strategy deals with which one, and just looking at them all individually. But Rich, go for it. Let's dive into the book a little bit.
All right. Well, firstly, Simon, it was a great book, really good book. I read it from cover to cover in one sitting. Really good read. Tom's done a great job, and but what I love about it is that my head was nodding off my shoulders as I was reading it, because there are so many commonalities between Tom's approach, and I agree with it. So massive diversification across markets, products, etc. ETFs, futures, whatever you can get your hands on. Then there's massive diversification across systems. I'm loving those principles. But the only time my head was not shaking it off my neck was on the volatility targeting comment. And Tom, so can you please lay down for me the reasons why you're an advocate of volatility targeting?
I think it comes down to objectives. When I was a money manager, I think if you're smart as a money manager, and I don't think a lot of money managers are necessarily smart, they have this mentality of, all right, I'm pretty wealthy, I'm going to trade my own money, and if you clients want to come along for the ride, you can. And I'll just trade your money just like I trade mine. I reverse that. I approach the money management industry from the standpoint of, what do my clients really want and are comfortable with? And I will tolerate whatever they need for my own money and make mine, I'll just go along for the ride with my clients. And in that effort, I really, really became convinced along the way that return to risk was the most important thing I had to worry about. I had to try to keep the risk extremely down, or people were going to fire me. And if I produced profits, they didn't need to be the 40%, 50% returns. That almost scares some people. So I needed to, dial stuff in with a low leverage, keep the drawdowns down, and get a high return to risk ratio. Now, when you're talking about volatility and volatility targeting, or whatever you want to, I can call it a number of different things. I call it like volatility limiting my portfolio. It's an effort to try to make sure that you don't enter into the client's mind, or in this case, the trader's mind, my mind. And when something's very volatile, like it is today, you're more likely, it's going to catch your attention more. If you have a really boring day and you look at the screen and it's a plus or minus 0.1% on your portfolio, that's not going to draw your attention. It's not going to create any mindset problems, not going to create your clients are not going to get nervous and want to fire you. But you're not producing a lot of returns. So you're trying to get enough return to satisfy your objective while at the same time never putting yourself into the stress of being a highly leveraged trader, in my mind. That's what I shoot for. So the volatility targeting, when I look at a position, I look at it from a risk as a percent of equity and a volatility as a percent of equity, because the two are both very different forms. Volatility is not risk. Risk is how much money can I lose on this trade. Volatility is how fast is this thing moving.
Yep.
And I like to limit both to a specified number that I, as a trader, feel comfortable with both of those levels, and I don't exceed them. Now, if I'm into a position and it's going my way, I have a second set of limitations that are higher than my initial position. So if I start with like a 0.5% risk, I'll allow a position to get up to 1% risk if it's profitable, because I'm sort of playing with the market's profits. And I haven't been able to move my stops up fast enough, and so I give it a little room to grow. Same thing with volatility. If it's definitely on the profitable side, there's a tendency over the lifetime of a trade that's very successful that volatility will tend to increase. People will get excited about it. You'll get more noise in the market, more movement in the market. So I like to give it a little more volatility if it's a profitable position, because the market's getting more exciting. But that being said, there's a limit to my level. On volatility, I would probably start with 0.3% of equity volatility, and I allow it to grow to maybe a 0.5%.
Yeah, so you're not a Paul Mulvaney. You're not going to swing it out of the baseball park, but you are going to bias your system to capitalize on positive skew events. In other words, capitalize on beneficial volatility to a degree. Mm-hmm. And I was going back over your history where you said one of the big trades that made you realize about the type 2 area, missing out on the big one, was that silver trade. And I was thinking to myself, back in the day, Tom, where you missed that trade, would you have applied volatility adjustments to that trade back then, or at that stage where you're trying to hit it out of the park?
No, that was very early, Tom, and I hadn't figured out volatility adjusting things yet. And I hadn't even at that point really even read the Larry Hite chapter in First Market Wizards that talked about making his bet size on every single trade the same, which triggered my mathematical brain into saying, you know what he's doing? He's taking the risk on the trade and he's dividing it by the equity probably, and he's limiting it to an acceptable number, whatever that is. So I started doing...
You're a chemical engineer, Tom. That would have... Yeah, I can see your brain working on that one.
My brain was just... I was reading this and I'm going, I can see the formula for this. So... and those formulas right now are in the Successful Traders Size Their Position book. Those are the same ones I created, 40 years ago now. I've been using it.
Tom, were you on the cocoa trade, this recent cocoa trade?
Oh, yeah.
And how did you find, so you did sort of maximize your beneficial volatility to a degree, but I noticed that a lot of CTAs were selling into that cocoa trend this year, where some of us were sort of holding on for dear life, and we certainly weren't selling into it. But I just can't understand the rationality of selling into trend.
It's just, for me, I don't want cocoa to dominate a 35 position portfolio. Yeah. So I start out with whatever I start out in the initial position, and then as the volatility gets totally, almost historically ridiculous, I'm just I'm trying to downsize the position slightly to get it back into the portfolio as a part of a portfolio. I don't want it to be the portfolio. I don't want to have one cocoa trade that's massive and 34 other things that don't make a difference.
Okay.
Sounds a little
That's-
like Perry Kaufman. We talked with Perry the other day. I think he does some similar things, and I do appreciate the trying to find the balance between the outlier hunting. And Tom, you are an outlier hunter. You're looking for those occasional big moves that are really going to move the needle on your portfolio. That's how you trade. And then at the same time, you're being aware of the statistical significance and the probabilities of things being so overstretched.
Yeah.
That they're likely to start to revert. And so you also want to capitalize on the statistical significance of that.
Yeah, if your objective as a trader is flat out make the most money possible, I would agree with Jerry Parker's constant comments about you should never volatility target or anything like that. You shouldn't be selling off your position. You should be holding on for dear life and letting it run as far as it can run. That is for pure profit. I think if that's what your goal is, that's fine.
Did you hear that, Jerry? We're all good here. We're all good here, Jerry.
I've known him. I used to compete against him back in the day in the 1980s. He would get one account and I'd get another one, and but I've known him forever.
Nice.
It's just that to me, return to risk made more sense for my business. It smoothed out my ride, it smoothed out my mentality. It allowed me to be Mr. Serenity, I suppose, from Jack's standpoint. And I think that, did I make less profits because of that? Absolutely, yes. But did I take a much easier ride, and did my clients feel a lot more comfortable with what I did for them? I think the answer is also yes. And I think that's where you have to decide what your objectives are before you really design what it is you're going to do as a trader. And that's why every trader out there probably should be doing something different, because we're all unique in our own makeups, our capital we're trading, our knowledge levels. I mean, there's traders listening to this that perhaps have never traded a futures contract. I've traded futures contracts for probably 45, 50 years. So to me, it's about as easy as breathing. To somebody who'd never done it before, it's very intimidating. And so you have to try to take what you have in your brain, what you have as resources, how much capital are you going to trade? I've got some good sized portfolio, so I can diversify. Jerry's got, in standpoints, trading $1 billion. So Eric's got like 75 global macro markets, futures markets that he trades. He can do that.
For context, you're the chairman of Standpoint, the fund that Eric's trading.
Eric Crittenton has been a friend for many, many decades, and he put together the mutual fund, the BLNDX, Blendex, and there's also a smaller version called Remix. Same concept, just one's got a different fee structure than the other for smaller investors. And they're trading over $1 billion now, so he can afford to spread it around to a great number of markets, and it makes a lot of sense. And he had to design everything he does for, multi-billions of dollars that they are on their way to getting to. In the case of me as an individual trader, now retired, I've got a completely different objective than Eric does. So I come up with different solutions to my challenges. And I would submit that, both you, Simon, and Rich probably don't trade exactly like each other either. Why? Because you have unique challenges and unique situations that you're trying to solve.
And he's from New South Wales as well, Tom. So, we forgive him for that.
We're from different sides of the channel at the moment, just because I moved. But this actually reminds me of our last conversation with Andreas Klenau as well, where he made the point, of course, that trading is a commercial decision, and in fact that trading your own money is the worst trade that you could make. You're better off trading somebody else's money for a variety of reasons. But if you are trading or trading other people's money, then you're constrained. You're constrained by what your clients want. If someone gives you a big stack of cash and says, "Hey, I don't like the way you trade. Can you do this?" You're more inclined to listen, and than if you're trading your own money. So you do have to fit your trading to the objectives.
I can give you a great example of exactly what you just said. About a couple years ago, I was watching the crypto futures. And I'd never traded crypto, had no interest in it, whatsoever. I was quite comfortable doing what I was doing. But I was looking at the futures and the volumes were coming up. They now added the micro ether contract, the Ethereum contract. It was CME. I'm comfortable with them. I have good exchange. They've done a lot of innovative things over the years. So I said, I'm going to throw those two charts up on my IB screen and take a look at it. And then I'm going to look at it and say, well, what kind of time period am I interested? I don't want to trade this thing every day and not interested in that. I'm enjoying retirement. And I ended up with about a 9-day set of indicators that I used Keltner, Bollinger, and Donchen channels. And I take the first one hit, and it's 9 days. And that's my whole strategy right there. So and then I did my position sizing, so you got, you might, the Bitcoin contract is a lot larger than the Ethereum contract is. So I'm getting a lot more Ethereum trades and in terms of numbers and less on the Bitcoin. But when you get all done with it, I said, that thing just moves a lot. It moves up a lot. It moves down a lot. I don't have to have an opinion on it. It's just one more trading vehicle. So I created one of my strategies called the crypto strategy. And then that becomes one of my strategies. And I just trade two things in that strategy, and I trade it with the 9-day. Done.
Mm-hmm.
So that's a good example, but a good example of what you were saying about having clients. If I did that in a client portfolio after trading futures for them, there's a percentage of clients that would fire me immediately.
Yeah.
Because they're anti-crypto or they're anti, changing anything. You're changing your strategy. Why are you changing your strategy? You've already been successful. We've made money. And then you end up explaining to these clients that you're trying to progress and get better at what you're doing. I don't have to answer to that anymore.
Yeah, I was going to say, did you enjoy working for clients' money, or you're much happier now?
Much happier. Much happier.
Yeah.
I don't agree that the best way to trade is other people's money. From a standpoint of making as much as possible, yeah, I mean, if I'm trading 600 million and I've got a nice incentive fee and I turn in a 15% year, I'm going to pay $1 million in taxes.
Yeah.
You're going to make a lot of money. And that's all good and fine. But I think I'm not going to poke fun at any one trader. I would say this, that from my own personal view, I have about as high a quality of life as anybody on the planet. And if you handed me $10 million, all it would do is go into my portfolio, add a couple zeros, and I'd be doing the same exact thing, living in the same houses, driving the same 2019 Kia Sorento that I love.
You'd be coming out to Australia too, Tom. You'd be coming out to Australia with that money you earned.
Well, I would probably, nice. If I had another $10 million, I'd probably add a few more markets. I'd probably start looking at some of those other markets that Eric is trading over at Standpoint. But I'm quite happy with everything that goes on in my life. And so this obsession with trying to, let's say, screw your life up by trading other people's monies. And, back in the day, I was doing round the world trips. I'd start out from Phoenix and end up in Hong Kong for a conference, then go to Geneva, and then go to London to do appointments, and then wash my shirts at the hotel and go to New York to do appointments all week. And then I'd come back and I'd be in Phoenix like 24 hours. And then I'm on a plane to Japan for a book tour or, interviews on television or whatever. And, as you get older, that doesn't
No.
That doesn't work as well as when you're 22. So I have to say, I've slowed things down quite a bit. My wife still gets me on the road every now and again, and we've been talking about doing a cruise down, actually starting down maybe in Sydney. We're not sure.
Oh, that'd be good.
Let us know.
We may do that next year in the spring sometime, but haven't made a final decision on it. Haven't got the itinerary. Don't even know which cruise line we're going to go on. But the point I'm making is that I don't have this pressure to be on an airplane all the time. I don't get interrupted having lunch by a client call coming in and wants to know how come we lost money last month. Life's a lot simpler and
You're
easier.
living the life, Tom. Like even where you are now, I just want to look through that window and see your mountains you overlook. That would be very impressive.
I tell you what, go on. Let's see, is it my Facebook? The background on my Facebook page, I think, is a picture from my back deck.
Okay.
So you can see what it looks like.
I'll check it out.
Yeah.
I mean, this is why we like the path of independent trading, because we don't have to put the suit and tie on and deal with the corporate life. This is way more fun. So in terms of how you trade your own money now, you're a big all-weather guy. So you've got multiple different strategies. Can I start with asking Tom? You're one of these guys who trade both futures and you're in the equity market. So
And
a lot of guys just trade futures. Okay, so what is it? It's just
stocks,
ETFs and futures?
I only do ETFs, and I'm actually in a phase out of ETFs, phase into more stock index futures. It's more efficient from a capital standpoint. It's more efficient from a taxation in the U.S. standpoint. And I find it just as easy to trade. And I can go both directions. I can go short the stock index futures, which was very nice today to be short. Not so much nice in the aftermarket here. Some of the markets are reversing and going the other way. So, but that it's just another day of trading. The point I make is that when I first started out, ETFs started being the what would you call it? Sort of the anchor, the core position in the portfolio. And then I added in strategy after strategy, and I got it up to about 10 strategies. Some of the strategies, the math was exactly the same. And I thought, why am I calling that a strategy and this is a strategy? I did put it all together and make it one strategy and consolidate it. It's a little easier on the computer to just run through that whole strategy and get all the orders done and get them shipped. And so I consolidated 10 down to 7 that I think I still have. And some cases it's a different strategy for my IRA, let's say, than it would be a set of strategies for my taxable, because there's different legal restrictions on what you can or cannot do with a retirement account in the U.S. You can't short securities, for instance, in an IRA. You could at some brokerage firms, and Interactive Brokers is one of them, if you're willing to pay 3 times the normal margin, they will allow you to trade futures there. And so I'm able to do some futures trading. But because of those restrictions and the extra margin, I had to create a whole strategy in itself just to trade the futures inside my IRA. In my taxable accounts, I've got multiple long-term, short-term strategies for futures, and I can do a little different things there because the margins are lower, and I can make that all work.
I was just going to say that's another example of how there are these other constraints on us as traders, and we have to design systems around that. And okay, so just I'm curious though. For now, in those ETFs, I've heard you talk about something to the tune of 30 sector ETFs, or like what's that ETF universe look like? Is it just US stock sectors, or are you actually trading some bond ETFs and currency ETFs?
When I traded, I'm down to 2 positions left. out of 30. It was basically just go down the list, do a quick screen on a sector. So just say, okay, semiconductors. Screen the universe of all the semiconductor mutual funds. Get down, or ETFs, I mean, and get down to the ETFs that are listed. Take a look at them and decide whether or not your the fee schedule is correct. Do you have any restrictions? Is it liquid enough? Does it trade 100 shares of the ETF per day, or is it more like 200,000 and it's $1 billion worth of capital being traded every day? And I'm going to be nothing. I'm just going to go in and out, and nobody will care whether I'm there or not. And so that's what I'm really trying to look for. And I just use some common sense. It makes some sense to me to have a utility fund, let's say, in there, a utility sector for safety, for yield, for interest rate play if there is one, some tech, some energy, some precious metals.
So, Tom, you're using logic to develop an uncorrelated suite as opposed to correlations themselves. That makes sense to me. Yes.
And the reason I do that, that's a good point. And hopefully people can learn from this a little bit. I think the obsession with doing correlation matrices of 30 different positions against themselves, which I could easily do. I know the math and could do it with a spreadsheet if you wanted. The reason you don't do that or become obsessive about it, let's say, is that correlations are always changing. And just like we were talking a little earlier before we came on about on a day like today where there's been this massive sell-off in stocks, there's a lot of either positive 1.0 correlations or negative 1 correlations. And the very next day, they might switch back the other way. So the minus ones become plus ones, and the plus ones become minus ones. Yeah. It's a concept I call lockstep, is what the term we used at Trendstat days, to just say that everything in your portfolio is moving fast and together. Yeah. Not necessarily in the same direction, but they're all either helping you or hurting you, but they're doing it in lockstep. And it's a dangerous condition from a trader because, from a trader standpoint, because you're taking on much more volatility, much more risk. You're going to have the potential for some large moves in your favor and some that might go against you. And I think that they usually last, locksteps will last for a few days, and then they break apart and we're back to a diversified portfolio. I think there's much more, it makes sense more to me to say, if I'm buying or selling a hog contract, what would that have to do with the price of gold?
Yes.
I don't really care. Yeah. I don't care what the correlation coefficient is.
Logically disconnected.
You know what I mean? It makes a lot more common sense to me to just carefully select what you're doing and say, hey, Japanese yen and live cattle.
Yeah.
What do they have to do with each other?
Wagyu beef. That's what they'd say.
Yeah, Wagyu beef. Yeah, I guess. And then you could hedge the yen exposure. I try to keep things simple.
Where I'm going with this is, I guess you're splitting things logically across futures and the ETFs. It sounds like when you're selecting your ETF universe, you are focused on the US markets. You're not actually adding bond ETFs or like real estate ETFs or international equity ETFs. Are you letting the futures contracts handle some of those other markets, and your ETFs are focused on US sectors?
Correct. I think it's more efficient for me to get a return stream out of silver and gold rather than to try to get that play out of an ETF. I can dial the leverage in wherever it is appropriate for my own objectives in terms of my temperament and in terms of the risk I'm willing to take on. using a futures contract where in the case of an ETF, the ETF manager is controlling the mix of silver and gold and whether he's buying miners or whatever, and I think it's a little harder for me to control what's going on there, and it's more expensive for the amount of capital.
And have I seen that there are actually now futures on the US equity sectors? I thought I saw that recently.
I have not researched it, but yes, I've heard that myself.
Yeah, okay. That's interesting. They could be a viable alternative to the ETFs as well then.
That could be a future project for Tom.
There we go. Put you to work. Okay, so you've got the ETFs and the futures. Are you trading otherwise very similar strategies across those two, or are they really ETF design strategies that are different to the futures?
Yeah, one of the problems with trading the ETFs, which I didn't mention earlier, but it has triggered some trades where there's this thing called wash sale rules in the US, where I think you have to hold something, I want to say 45 days. If you take a loss and then go back into it inside of, I want to say 45 days, don't if you're listening to this interview, check with your CPA to make sure. I'm not a CPA. But if you turn something around quickly, the IRS, the Internal Revenue Service, just says you can't take that loss then. We won't, because you're basically taking the loss, reducing your income that we can tax you on, and then you're going right back into the same position again. So when you do futures, you don't have that issue. There's no wash sales.
Okay.
So if I were to be able to do a futures of various sectors, I would probably be able to, if there's enough liquidity for it, enough people trading it, enough continuity of pricing and all that, then I could do that without having the wash sale rules. And that makes a lot of sense when we're over in my taxable side. When we're in my IRA, I am not taking gains or losses because it's tax deferred. So you got a whole different set of challenges, whole different set of rules, legal restrictions. So what I try to do is design what I'm doing for each of those portfolios, depending on what that portfolio's own issues are. Tax-wise.
That would be fairly similar philosophically, but you might tweak the model to account for some of the tax implications or the holding periods, that kind of thing.
Yeah, the holding period of the sector funds would be longer because I'm trying to get outside that wash sale rule, where if I'm trading cryptos, I can do a 9-day, I can buy and sell it inside the month twice, and it makes no difference to anybody.
Tom, so I understand this. There are two ways you could attack this. You could either say, all right, I've got this array of universal models, and now I'm going to plonk them into the futures market and the ETF market. So what I'm going to do is, for the tax reasons, etc., for the ETFs, these particular models I'm not going to apply. So you're restricting your universal models to that for the ETF, but then the universal models might all apply to your futures market. That's one way. The other way is to uniquely design your systems for each market. Which do you take? Is it?
I try to uniquely design them for each specific challenge or situation.
Okay.
So I trade some strategies in the IRA that don't get traded in the taxable, and I trade some in the taxable that don't get traded in the IRA.
Okay.
But across all of them, across all the accounts, I trade 7 different strategies.
Okay. Right. Let's talk about those, Tom. So can you give us a high level on what those 7, the themes of those 7 strategies are? Are they
let me
stretching everywhere from mean reversion to trend following to short term?
Well, the first one, I don't trade exactly mean reversion. I'll get into that in a second. I trade
Thank you, Tom. Thank you, Tom.
I don't trade mean reversion. I'm very uncomfortable trading mean reversion.
You're both just chicken.
Mr. Serenity would not be serene anymore.
Yes.
My first strategy that is done in my taxable account would be a long-term strategy that covers 35 futures markets. And that is, I don't know how to describe it except that it's a math that I call it point and figure bar. It's sort of a conglomeration that I created myself back in Trendstat days of bar charts and point and figure charting.
Okay.
And so I call it PF bar. It's long term though. I could stay in a
Quick
position.
comment on
I could
on
stay
that.
in a position like Japanese yen. I could be in Japanese yen for the next year using that.
Just a quick comment there. You say that you developed that back in the Trendstat days, Tom. I think that's testament to finding robust strategies that really do stand the test of time. That's impressive.
Yeah. Well, one of the things you'll notice with all of the indicators that I'll talk about is this tendency to have an adjustment for market conditions or volatility at the moment that you're trading. So, for example, if you used a Keltner band would be a moving average. I like exponential moving averages myself. You'd get, say, 21-day exponential. Then you take the average true range, probably over 21 days as well. You multiply it times some factor, and you have a line that's above the market noise and below the market noise. So you got, if I did my hands like this in the screen, you got this noise band between the two hands. So this middle region is noise. Above my top hand is the buy zone. That's the uptrend. Below the lower hand is going to be the down trend, and therefore where you're going to be
So
selling.
a nice little breakout.
Yeah, and so but why do I like that particular type of indicator? Number one, it allows the market some normal noise in between those two lines. I think that's very important because you don't need to trade all the time. If the market's going sideways and doing nothing, you're not going to make any money. You probably cost yourself whipsaws and things. Just take a chill pill and ignore it.
Yes.
On the other hand, as you start getting above that line, you want to go long. Below the lower line, you want to go short. Now, notice that because it was based on the average true range on that particular indicator, the Keltners, when you have a very quiet market, you're going to have those two lines very close to each other. And when you get a volatile market, what's going to happen? You're going to give more room for the noise. And this is going to happen automatically within the math of the indicator. So all my indicators, whether it's a point and figure bar or Donchens or Keltners or Bollingers, all of them have an aspect of volatility associated with them, so that when price excursions and movements in prices get wider and get more volatile, like we saw today in the stock market, my indicators are going nuts here, stretching out those lines, giving the market noise a little bit more room these days. That to me helps stand the test of time, because as volatility and market conditions are changing, your indicator is changing with it.
Yeah.
It makes a lot of sense to me. When you have let's say you did a 10-day moving average against a 50-day moving average, no flexibility at all. It is what it is. You're stuck with it. I don't care whether the markets are volatile or quiet. You're doing a 10-day against the 50. There's no adjustment to it. And I
love the fact that you're not in the market at all times, because that makes eminent sense to me, because and by not being in the market and avoiding the noise, you're avoiding the bulk of the distribution, pushing your trades out more to the tail regions. So if you look at your sample statistics from your trades, by not participating in the markets all times, you are getting a skewed distribution, which is what you want, which I love. The other thing, Tom, you're famous for the random entry experiment, and that always blows me away. You're famous for that. So just to explain, Tom did a very interesting experiment where he looked at random entry signals in conjunction with conventional classic trend following, trailing stops, and exits. So it effectively forced the conclusions to show how important the exits were, and how the random entry was more just a need for a random entry to create an uncorrelated result. And I think it was a fascinating experiment. And I'm wondering, with the systems you're trading now, the Keltner, all of these different systems, are you searching just for an uncorrelated suite of entries here, or is it deeper than that? Is it linked to that random experiment?
I think I'm looking for the outlier and triggering it with all those indicators. And I didn't know cocoa was going to do what it did. Last year it was orange juice. It's always surprising to me where I make my money.
Yeah.
I have nothing to do with predicting where the next big profit's going to come from. I always have some markets that I'm queuing up and watching and seeing if I can add them down the road to the portfolio where it makes sense for me to do it. And I'm just trying to, do an assessment of, does it trade enough? Does it, are the price charts fairly continuous so that I don't expect big gaps in my fills and that type of thing. So no, I'm just trying to, I'm trying to allow the market the room for noise. And then I'm trying to say, whenever it's outside that noise range, that's information. So I'm separating noise from information.
Yep.
And as a chemical engineer that I used to be, or still am by degree, I guess, when you're in a chemical process and you're trying to temperature control something, and the temperature outside's going up and down with the evening coming in, or the nighttime, or the hot sunny day, or the cloudy day, you got different
noise
outside conditions, and you got the inside conditions. You got the chemical stream coming in, you're trying to heat it. You need to get it up to this temperature to combine it together with another stream of chemicals to make some third stream of chemicals. And all those are precise measurements, and you're measuring this stuff. And in instrumentation land, and you can think of this with your thermostat in your house, you can't make an adjustment immediately because you'd be adjusting all the time. You have to give it a little room. So maybe in the case of your thermostat, you say, well, if it gets 2 degrees centigrade above where my set point is, then I want to kick the air conditioner on. And if it's 2 degrees below, I want to kick the heat on.
Yeah.
And you're giving it that noise to allow outside conditions and the fact that you might be cooking dinner and there's a lot of steam coming up from the pot. Just a lot of things could be going on. You could have 50 people and you're having a party and all the body heat is driving up the heat. Lots of different reasons could cause it, but you don't, as the instrumentation control loop doesn't kick in immediately, it gives a little bit of noise before it makes its action actually, kick on an air conditioner or turn on the heat. And I look at markets the same way. I want to give the market room to just do its nonsense that it does every day and can't make up its mind which way it wants to go. And when it gets outside there, that's why I want to take a
great analogy.
I don't want to steal a thunder, but can you please explain your random entry experiment, the conclusions you found?
Well, it was just something that I was trying to understand position sizing and trying to say that really your entry signal to try to, new traders are great for this. They open their account, they get on their trader platform, and they see that list of indicators there, and they go through and they put up just about every indicator that the brokerage firm has on its website, and tries them all and looks at the chart and say, "Oh, that'd be cool. I picked up this thing," and then whatever. They're always obsessed, and I was too when I started out, obsessed with where to buy and sell, all about the buy-sell indicator. And I decided, I'm getting a little more experienced as a trader, and I'd like to be able to show people how little it matters about where you get in, because all you're really trying to do is to be in on every major move of any market that comes along, and you don't care if you're, like for instance, if I had an indicator that put me short 2 days ago in the stock market, and I had some other indicators that put me short Friday, and I came into today, and the market collapsed. So all of those, no matter which buy and sell engine you're talking about, picked up today's move. It didn't make any difference. I could have just as easily last Tuesday flipped a coin, and it comes up tails, and therefore I got to go short because tails is short, and heads is we're going to buy. So what I did was I took 20 markets basically in futures. And I took about, I think it was 10 years of data, or it was a fairly good amount of data. And I did the random number generator to buy or sell. So heads we buy, tails we sell. If we don't have a position, at the end of the day, I flip the coin. Now the next morning, if it's heads, we're buying. So we're now long. I then would take a mechanical stop loss, trailing stop loss system behind it. And I just did something very generic. It was something like I think I started with a 1 times ATR or something, 2 times ATR stop, and just kept trailing it. And eventually it would stop out. And I did my best position sizing. So I had actually the same risk on every single position as a percent of the ongoing changing equity. So I did my best job there too. And then because every time you run through it, you get a different result because you're flipping a coin to buy and sell. So then I said, well, to take care of that, what I'm going to do is put it in a loop and run it 1,000 times through the data, get 1,000 different runs that are all going to be randomized, and I'm going to average them together and see whether it has a propensity to make money. And it turns out every time I ran the 1,000 cases, I ended up making money. Now,
you almost became the world's best CTA. You almost became the world's best CTA with that random generation, Tom.
No, I would not want to trade that way. I thought it was pretty dumb. I think you can do better with indicators, but it did drive home the point that all this obsession with when you get into the entry signal is not as important as just doing all the other simple things in trading, letting the gain run, cutting the losses short, position sizing it properly, doing all those things, having a diversified portfolio, doing it over thousands and thousands and thousands of trades. You're going to get a big statistical sample. If you have an edge, it's going to show up. You're going to keep it smoother because you're position sizing properly. You're running a good diversified portfolio. It's not as good as coming up with a good entry. I think that adds a little bit of benefit, but it certainly speaks to don't obsess over your entry as much as most people do.
Yeah.
Tom, on the diversification you just mentioned, so you mentioned wanting to be on those big moves when they do occur, be it cocoa, be it orange juice, be it Bitcoin. How much diversification is enough for you? Like, are you trying to constantly expand the size of your futures universe? I think you mentioned about 30 contracts. I mean, is that enough, do you think, or would you like to be trading 60 or 100?
35 is enough for me. If I can automate it more totally, I could stand to have a few more, like 40, 50. There's a point of diminishing returns whereby you're just doing a lot of extra work. And unless you have unless you're going to trade milk or something completely off the wall that hardly trades at all, and then you got those issues with liquidity. I think that you're getting a diminishing return because the very small slice of that one position is going to have a really hard time making that much of a difference in your total returns.
So how did you manage to...
If I was a new trader, I would suggest that 10 is a good starting point. And If you got a more substantial portfolio, I would argue 20 to 25 is pretty good. If you got a much larger portfolio, I'm up at 35 now. I'm looking at one more market maybe to add. Am I really doing myself that much of a favor? If it's totally automated and it's not a lot of work to do it, sure, you can go ahead and do that. If you're doing it all manually, I would suggest that's not worth your effort.
So how did you manage to jump on the cocoa trade? Because if traditionally it hadn't trended in the past, it might not have really been on your radar. Was that just a logical decision when you saw it move to add it in, or
No. I've traded it for years. I've traded it probably for, 20 years at least. I'm fine with trading something that has lost me money. I can go into any market that I trade probably and find a period of time where I lost money trading it. That's not the criteria at all. It's does it have the potential to move? Does it have enough liquidity so I can get in and out of it? That's the only thing I worry about. And then, somewhere along the way, you have a bug that is going to eat up the corn crop, and all of a sudden corn prices go crazy. Or you have a drought down in Brazil and soybean prices are making a move. And I never know what it's going to be next. A war breaks out and crude oil goes crazy. I don't agonize over what might be. I just figure as long as the market is free form enough to allow buyers and sellers to push the prices around and I can get in and out easily, then I'm happy to trade it.
Okay. But Tom, the intent is to get uncorrelated return streams. That's the intent, isn't it?
Correct.
So when we're talking about how much should we expand into market diversification, and we're talking about diminishing marginal benefits as you're increasing your level of markets, because the correlation benefits sort of decrease as you increase. But in the world of outliers, that tends to throw the spanner in the works there. However, when I'm looking at this and I'm saying, Tom's got multiple systems, he's got 30 markets, but the reality is that Tom is quite highly diversified, much more diversified than someone trading a single system on 30 markets.
Correct. Definitely correct.
Yeah. So
100%.
This diversification argument, I think we've just got to be careful. We're looking at the combination of market diversification and system diversification, all the forms of diversification.
And diversification by time.
And by time frame. That's right.
Let's take a little digression here and talk about mean reversion.
Okay.
The reason I don't do mean reversion is it drives me nuts to think about a market like, for instance, the market today is crashing. And we're setting records. The NASDAQ's never been down this much ever in its history. And the Dow's down over 1,000 points and all this stuff. Mean reversion means you got to be in there and buying that and setting your stops. And you're out in the middle of the wilderness, as far as I'm concerned. There may be no logical reason for that thing to turn around, and you're just hoping it does. That to me is insane. Now, what I do that would look to the outside observer kind of similar to that is I have something called counter trend that I use. That's a very short-term trading strategy, and it comes off of an overbought, oversold indicator. So, for example, on cocoa, good example, cocoa's going up and up and up. The long-term strategy is picking up tons of money, riding the gyrations up and down. But when you get to a point where it's just spiking every day, going up and up. Orange juice was doing limit moves back in upward back in 2 years ago, or last year, I guess it was. Your stops are getting very far away, and as a trader that sooner or later it will top out and go all the way back down, and it's going to eventually get to that stop, even though you might move the stop up a little bit in the meanwhile. But you're going to, from that peak, which is where you start your next drawdown, you're giving up that much risk on that trade to get to the stop. So what I do is I create a second strategy, let's call it counter trend. And I could say the cocoa market is very overbought. So clearly that sets up a counter trend short sale. But I'm only going to do that on an extremely short term indicator like a 3-day Donchian, something like that. Not something long term, 21, 50 day point and figure bar, anything like that. Now I'm going to be right off the top, almost within a day or two, I'm short on the counter trend strategy. I'm still long over here in the long term strategy. Guess what? They sort of even out, they counterbalance each other, and my position goes to zero. Now, a couple things can happen then. It can continue to be a zero position size and it goes all the way back, stops me out of my long term strategy and puts me short on the long term strategy, in which case now we're in a full blown bear market in cocoa. Or a lot of times what will happen, and it happened this year, markets can't make up their mind. So the counter trend will come on and go off, and the long term stays in there and rides it for the long run. So you're going to long position to sort of flat position, long position to flat position. You might be reducing your overall returns because some of those short term trades are going to be losers. And what you end up with is a much higher return to risk ratio on the whole portfolio. And to me, that makes sense for me, trading multiple strategies. One's very long-term, one's short-term, and they're fighting each other when it's appropriate for them to be fighting each other. And when they match up, boy, when you match them all up like we did with the stock shorts today, that gets very profitable.
Tom, you're mentioning a very important point here, because a lot of people, when they're looking at their return streams, they're looking at correlations, basically. But what you're saying here is that with design modifications, we can create almost co-integrated relationships in our portfolio and get the benefit of knowing that we're going to get a hedged component when we get the end of our trend. We're going to get the counter trend coming in. So with these deliberate design statements, you are forcing this level of uncorrelation into your portfolio. That is a
Correct.
really subtle and very important point that I don't think many people take advantage of. And I think that's the engineer in you, Tom.
Yeah, probably. I definitely design these things and the logic and the math. I mean, that's why, like point and figure bar, I just had a desire to have something that did certain things. And I threw a name of point and figure bar on it just so that the computer people at Trendstat would know what I was talking about. But had to give it a name. But the math behind that is very specific. It's easy, not easily, but it's programmable. Let's put it that way. You can tell a computer how to do it. And so to me, you're taking a challenge that you face as a trader, whether you're individual or institutional, doesn't make any difference. You got a challenge you're trying to solve, and you're designing the logic so that you're picking up the types of moves that you want. You're getting the numbers of trades per year that you want. I mean, some people, if you're a traveling salesman and you got some strategy you're designing that's going to trade twice a day, that's not going to work really well. You're going to be on a plane and can't follow through on something or get stuck in a position. You might want to do a weekly trading strategy and design it so that you update it on Saturday morning and you put in your orders for the Monday morning open and go back on a plane someplace. You have to take what you've got, the capital, your situation, your knowledge base, the markets you want to trade. All of those things factor into what the answer is you come to. And a lot of what I've done with, say, counter trend trading in the long-term futures are designed to counterbalance each other and you try to basically say to yourself, all right, I got this long-term strategy. What is the good points of that strategy and what's the bad points? Lawrence Bensdorp, who's a multiple systems guy, good friend these days, he calls it looking at your drawdowns as potholes. And you're trying to fill the pothole. And I love that analogy in my brain because on the track record going up the page, you got these big drawdown areas and you'd love to squash them up to join the rest of the line, so you have this nice smooth equity curve going up the page. And when you take counter trend and you put it together with long-term trading, all of a sudden I've squashed down some of the drawdown. Well, drawdown is sort of the denominator of return to risk. So you can improve your return to risk by minimizing the drawdown, not necessarily just focusing on increasing the return.
Really important point. It's a very design-led approach, and as you build, there's no holy grail. So as you build strategy one, you've got to be very cognizant of what the weaknesses of that strategy are, where things could go wrong, and therefore your next strategy is building to fill that pothole. So you're constantly in this design-led approach of how to construct a portfolio, not just a single strategy. And this reminds me of you've done a lot of talking about your hedging, and I'm not sure if you still run the separate hedge strategy or that's built into, but can you talk about that a little bit?
I'm still running the graphics over on the website, but I have not needed it now for my portfolio. So that's one of the strategies I dropped out because some of my shorter term futures strategies go two directions. So they essentially give me a downside exposure to any kind of positive exposure I still have. I only have 2 ETFs as of today left in my sector allocation, my sector timing. So I have very little long side equity exposure anymore, and I have more than enough downside to hedge it and then some. I'm really net short at this point. And so, yeah, you can run it or not. I mean, if I was running the 30 ETFs, I would still be doing my Standard & Poor's 500 hedge, and I still show it up on the website and have kept it up to date for people who are interested in it. But what I try to focus people on is, and a good example was one guy that said, I look at my portfolio, and I look at your Standard & Poor's hedge, and it just doesn't work. And what's in your portfolio? He says, well, I own about 5 tech stocks. Well, why don't you use the NASDAQ then? I mean, I'm not trying to get people to do exactly what I'm doing. I'm getting you to think about what you're doing and try to design something that would work for you. I had another guy that was a sort of a marketing guy, and he did a lot of Pacific Rim marketing, so all the countries around the Pacific Ocean. And so he knew several companies that he really, he knew a lot about the inner workings and the fundamentals and what he was able to sell in there and how successful they were and everything. So he put together a portfolio of Pacific Rim stocks, and he asked what I suggested. I said, well, can you find a mutual fund or an ETF that's just a Pacific Rim ETF? He looked it up, and I get an email the next day. Yeah, I found one. It correlates perfectly with my portfolio. I'm going to use that for my hedging. He said, great.
Right.
Home free. Yeah.
You've just mentioned, I think, perhaps now the third model. And actually, I was just thinking of Lawrence Benstorp when you mentioned that. I really do want to get him on the show now that I think about it, because I feel like him and I trade in a similar fashion, having listened to some of his other material. So yes, I'll key that up.
Yeah, he's trading 50 strategies. I've got 7.
Yeah. Okay, so we've talked about long-term futures, short-term counter trend, and you just mentioned sector timing. Is that the ETF strategy?
Sector timing is the one that I'm phasing out. We also mentioned the hedging. That's another one I phased out. We mentioned a crypto strategy. That's one of the ones I've kept, and I continue to do. Then I created an index timing, I call it. I wanted something that was intermediate term, and that ended up being about 2 weeks in time frame. So I used a 9-day indicator set, 3 different indicators, 9-day parameters on Duncan, Bollinger, and Keltner. And I did that to both the stock indices, basically, stock index futures, long or short all the time. It's either long or short, and it uses the upside line to buy it. It uses the downside line to sell it. and I do reversals both directions. So every major move of the stock market I'm in on, and I do that for both the IRA and my taxable account. So that would be another one. And then I decided
last
over
one?
in the future side, I had the problem of the margin, and I had the problem of wanting the futures exposure, but knowing that I was going to have the issues with the margin. So I decided what I would do. I would go very short term, so 3-day Donchins on about 35, or maybe not that many. It's probably about 26, 27 futures markets, long and short, long or short, all the time. So every major move that falls into that portfolio, I'm going to be in on with my IRA, and I can trade as many times as I want. There's no tax consequences.
Tom, that's
inside
fairly
the IRA.
short term. How do you deal with the noise in that model?
Well, I do get a little bit of noise abatement by using a 3-day Donchian, because anything that's happening over the short term within that band, top and bottom, I ignore.
Okay.
So inside days are ignored. Outside days might tend to trigger a whipsaw, but then get you on the right side of it. Sometimes it doesn't. You get whipsawed. But it's been cruising along pretty nicely. I mean, it's picked up this down stock market beautifully. It's picked up the upside of the bond markets beautifully. Picked up the cocoa trade.
Mm-hmm. Does that do these strategies generally always sort of have an ATR trail, essentially that kind of exit?
No, in the case of what I was saying, the 3-day Donchian, for instance, covers both sides of it. The top line is where I buy. The bottom line is where I sell. Don't need a trailer. The bottom line of the Donchian is the trailing stop.
Got it. And I've heard you talk about before, well, I've heard with your hedge strategy, you used to use the Donchian, the Bollinger, and the Keltner, and it would be whichever hit first, that would be your entry. Is that a similar?
That's a similar. I do the same thing. As far as I'm concerned, I'm measuring noise, and I'm using 3 different measurements of it. So I want the noise measurement that's the closest to where I need it to be for the order. Okay. So I always pick the first one up. So if the Keltner is the closest line to the market action, the Keltner will set the stop. If the Donchian is the closest, it becomes the stop. I don't really care which one it is. That becomes the stop. And then I just leave it in there, and I go out and play golf or whatever. And I come back in and find out what got executed today.
Mm. And do you run within, say, that shorter term or the longer term futures models, multiple different entries and exits, or multiple different timeframes within there, or that they are just singular strategies?
No, each strategy would have its own timeframes.
Mm.
If there was a different time frame, I'd call it a different strategy.
Got it. Yeah.
And I think Lawrence does the same thing when he does his 50. He has a lot of different time parameters that he uses, and I think that diversifies him by time period.
So keeping it simple, we haven't actually said that, but clearly that's a key part of the philosophy.
Yeah, you get diversification by market, by time, by indicator. You got a lot of diversification going on.
Yeah. But the strategies themselves, like, we don't overcomplicate it with a whole range of indicators and a lot of moving parts and filters in those individual strategies.
No, Jack Schwager used a term with me that just stuck in my brain, degrees of restriction. He said the more parameters you put into a system strategy or strategy itself, the more parameters there are, the more degrees of restriction you're putting on the robustness of that strategy. Yeah. And I find that to be totally true. I try to use as minimal filters as I possibly can. I have the one counter trend strategy where if I could think of a logical way to not even filter that with overbought, oversold, I might even give it a try, but I haven't become comfortable with that yet or figured it out. But
so we all agree The markets are very efficient. There is a small edge in there, and we need freedom to move to extract the signal from that noisy market. Yeah.
Right.
It's not an
So,
easy game, is it, Tom?
no, it's, over my lifetime, somebody I was talking to said he's never been able to get trend following to work. And I thought, wow, I've been doing it 50 years. I don't know. Um, I said, I think the reason might be just knowing this guy, having talked to him on Facebook, is that, I'm running 33% reliable probably over my lifetime. That means 2 losing trades for every gaining trade. If that's what you mean by trend following doesn't work, you're missing out on the fact that my average gainer might be 3 or 4 times my average loser. And so I can afford to take one profit and have 2 or 3 trades in a row that are losers, and I'm still ahead of the game. And so you've got to add this all up, and here's the way you do it. I gave him the math for expectancy, and haven't heard back from him, so maybe he's puzzling over my answer. I'm not sure, but
Nice. Well, you mentioned your friend Jack Schwager. You also have had quite a bit to do with Van Tharp back in the day.
yeah.
Can you share
Great
any
guy.
stories about the wisdom and the learnings from Van Tharp?
Yeah, one of the profound things that shocked me when he said it was he went up to New York and was working with an investment banking group, and they had hired him as a consultant, and he came in and took a Gambler's Anonymous criteria, which I think is 10 criteria to certify you as potential for Gamblers Anonymous. And he took the gambling language and turned it into investment language, but kept the same questions so that the investment bankers didn't know it was the Gamblers Anonymous survey. And it turns out, much to his amazement and to my amazement,
They're all gamblers.
somewhere around 35% of Wall Street were certifiable for Gamblers Anonymous.
Yeah.
Oh, that's funny.
Which is, it's kind of scary if you think about that. All those people managing people's monies. There's a lot of gamblers out there.
Yeah. Don't tell my wife, Tom.
You look at some of the moves of the Kathy Woods out there, and some of the big names that have been around, a long, long time. Even Warren Buffett and Peter Lynch and all these big names that would take bets on stocks and companies and ride them forever. And you're talking billions. And so I'm not saying that they're certifiable for Gamblers Anonymous, but 35% of them are maybe. It's a bit scary. And one of the things he and I talked about a lot was one of the reasons he used me as sort of a model trader for some of his seminars was that I was very methodical in how I approached things, and I tried to have a reason for it. And I do studies and try to mathematically simulate what it was that I wanted to do and make sure that it added value. And I think he wanted to try to get most traders a little bit more thinking logically like that, using common sense, taking control of their mindset so that they were prepared mentally to be a good trader and not let the markets just push their mental states high and low and all over the place, because that's not a good state of mind to be in, to be disciplined and to every day do your job and get your stuff done. And I think that he liked that in the way I approached it. So we had a lot of good conversations about how I maintained that kind of a stable state. We also had a lot of I think we talked a bit about awareness and self-esteem and stuff like that. Being aware that you're going high and to the right. You're looking at the markets and, oh my God, Dow's down 1,000 points. And being aware that all of a sudden that would give you a tendency to be excited. You're making a lot of money, or, oh my God, I'm losing my shirt today. Either way, you're not your normal, neutral, unbiased, good trader just running your strategies. You've now allowed your mental state to go high or low. Being aware that you went high or low allows you the ability to drive yourself back to the middle again. For instance, the markets are getting killed today, and I'm long, so I'm having a big down day. Okay, get back to trader self, get back to the neutral mindset and say, okay, well, I got some extra cash because I lightened up some of my stuff a couple of weeks ago. I'm going to go out and look for some bargains, see if I can find some stocks that are doing setups that I like. And when this thing turns the other way, I can jump on them.
So, Tom, do you do meditation yourself, for like being the independent arbiter, looking at yourself and saying, I shouldn't be getting excited here?
I've had a lot of people ask me that, and I tried meditating along the way. And what I found was kind of strange, I guess, but it makes sense to me. When I meditated, there was this tendency to try to just quiet the mind down to nothing. Mm-hmm. And that's actually how I go to sleep. I turn my brain off. I have the ability to stop my conscious thought stream. And as soon as I do that, I'm gone.
Here's Mr. Serenity. That's why Jack called you this.
Couple minutes.
You're born with it.
But here's the thing. Here's the thing with meditation. Meditation, you're trying to really quiet your mind down to nothing almost. But it won't quiet down to nothing. There'll be some things that come in, and you allow them to be there, and then you go back to blank, and you keep meditating some more. What I found more helpful to increasing my awareness of how my brain functioned was to try to think of my brain in two pieces. And you can do this on Zoom, by the way. So here we are is a great example. We're recording this. All right, so I'm looking at the image of me talking. Well, part of my brain has got to come up with what I'm going to say next. The other part of my brain can be watching me and say, wow, you're moving your hands a lot. Why are you doing that? Maybe just like leave your hands down here.
Oh, so
there's two
good,
parts.
Tom. That's control.
One's the observer, and the other part is actually carrying on the conversation. When you start thinking in those terms, and you can use Zoom calls, a great deal for this. You can do it in front of a mirror. You could give a talk on, I don't know, how to ride a bicycle, and do it in front of a mirror. And concentrate on having one part of your brain talk about how to ride a bicycle, while the other part of the brain is watching you give this little talk. And you're training yourself.
I hope your wife doesn't think you're a split personality.
No, she knows this about me. My wife's is a gem. She likes the fact that I go to sleep in 2 minutes. But is amazed at it sometimes, I think. But seriously, if you're trying to increase your awareness, try to do this. Just if you have a Zoom account, go on Zoom and do a meeting with yourself and just, I don't know, talk, record it if you'd like. They give you that ability for free. Then go back and watch it. Pretty soon you'll be watching yourself in real time and being aware of what you're doing with your hands. Well, how does I'm sitting here in a chair and I'm thinking to myself, my legs are a little stiff from playing golf yesterday. And here I am talking to you guys, and I'm thinking about my legs being a little stiff. I'm aware of so many different things that go on in my body and my mind now, just after many, many, decades of doing it. I don't even think of it as observing myself anymore. It's sort of just, I'm aware of what's going on. And I think traders would be well served to explore awareness, because it'll help them get the right mental state for good trading.
It's great. I love that, Tom. Yeah, I think the vast majority of people spend no time working on their own awareness. They barely know how they look from the outside.
Zero.
who they really are to the outside observer, and therefore they get no time spent on working on self, on themselves.
The other thing to think about with a lot of traders, and I think Jack Schwager fell into this a little bit, when he would do one of his chapters, he'd make a pot of coffee and then go transcribe the interview. Jack was a pretty wired New Yorker, and that caffeine, I know that when I'm very, very caffeinated, I lose some of my awareness. I also know if I'm drinking alcohol, I lose some of my awareness. And so I'm not against anything. I mean, if people want to, do whatever they do to their body, that, it's their body. They should have that right. But in my mind, I think you got to be aware of, if you're going into a trading day, it might be a good idea to back off the caffeine, maybe enjoy a second cup of coffee on Saturday when the markets are closed, maybe not Monday when the markets are crashing.
Okay.
Or switch to decaf. Caffeine is a nasty drug. Anything that when you stop taking it for a day, you end up with a splitting headache, it must be having an impact.
I'm a victim of all the Eames, nicotine, caffeine, you name it. I'm in there.
I've been trying to switch to brewing a decaf, Rich.
Good on you.
I know, mate. I won't be able to convince you.
No chance.
But that's been great. It's so important. And, trading to me, no matter how algorithmic we are, it always remains more of an art than a science. I still believe that. We're still making decisions, bucket loads of decisions in our minds every day, how we operate, which algos which kind of research we do.
They're just models.
We're switching on,
Everyone's got a model. It's just a model. It's not the reality necessarily. It's just a model.
I use my creativity in designing these strategies because I'm trying to fill that pothole, and I'm asking myself, how do I come up with a math that would catch those moves that would then tend to make profits when this other strategy doesn't? So you really have to think through the good points and bad points of your first strategy and then say, okay, I can create this different strategy that's going to tend to make money there, and that's going to balance each other out a little bit. And then I just have to figure out how to weight those and get them to balance as part of the portfolio. And I think that's where you're getting a lot of your creativity as a systems designer, as a trader, in the creation of your strategy. Once you get it and you're trying to operate it, then I try to turn the brain off pretty much and just execute flawlessly. Don't make mistakes. Do it exactly the way you designed it, without fail, without thinking. Just do it.
What kind of research do you do these days then? So you've been trading for a long term. You really do your 45 minutes a day of work executing. I think you've just given it away a little bit in terms of what occupies your mind now. What's the research process now? What's the continual improvement work?
I try to get a little more international diversification, so I'm queuing up the Nikkei futures contract and watching that. I just recently, about 3 months ago, added the European EFA contract into the mix. So I've got a little bit more. I am researching some markets that are futures markets offshore. Beyond that, in terms of trading strategies, I am actually measuring and logging in each day what I would call free equity that's not being used in my portfolios. And I'm starting to see my way clear that I can put a pretty tight parameter, plus or minus, around certain numbers. And then that's starting to lead me to think of how can I use that very effectively at the same time of trying to improve my return to risk ratios. What kind of strategy can I consume some of that extra margin that I'm not using, but help myself at the same time? So that's kind of where my mind is.
You've got the risk-adjusted return all nutted out. Now you're looking at improving your capital efficiency. So you're squeezing as much juice as you can out of your models.
I'm still trying to get the return to risk even higher, but I'm doing it by being more efficient with my capital.
Yeah.
So I'm looking for exposures that don't require as much capital, but keep me still very safe and diversified. Because it is my retirement account. I'm living off the portfolio. I don't want to be a crazy man.
The only
All
thing
right.
I want to say, Tom, I just want listeners to be aware of Tom's website, enjoytheride.world, because seriously, Tom, it is an amazing resource and everything you've ever done is in there. And so if anyone wants to know about Tom, that's the website to go to. It's complete. It's the one-stop shop.
The website is for the new trader that just wants some resources to start out and figure out what he's up against. And then if you need to contact me and ask a question, I can still answer those, but they're a lot more rare these days.
Well, now, Tom, you're pushing out your content too through Substack, which is a nice medium. We're doing the same, so people can follow you along on your Substack, which I think is also called Enjoy the Ride.
Thoughts from Enjoy the Ride.
That's it.
Thoughts. And then, because it's usually whenever I have some thoughts, I put them down, and that's why we called it that. And then the other, the big area that I get a lot of interaction with traders is X. The X platform is, I think I've got 54,000 followers now or something like that. It's crazy. More people know of me now that I'm retired than when I was actually a money manager, I think.
Rich, did you have anything else to ask?
No, all done and dusted. Thank you so much, Tom. Wonderful to see you. Really enjoyed it.
My pleasure.
Yeah, thanks, Tom. It's been great
was
chatting.
Fun talking to both of you. We can do it again if you want.
Oh, yeah, definitely.
Yeah, we'll definitely do that.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives. So nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.